Good afternoon, everybody. Welcome to the Innovacorp Investment Readiness Series presented by Startup Yard at COVE. My name is Shelley Hession. I'm the manager of Startup Yard at COVE, which is an Innovacorp incubator focused on ocean technology startups. So today is part 4 of our 4-part series, and our session today is entitled Closing the Deal. Our presenter today is Jonathan Saari, Investment Director at Innovacorp. So before I do John's introductions, I'll invite Jennifer Ficciullo of Innovacorp to say a few words.
Thanks, Shelley. Hi, everyone. I'm Jennifer Ficciullo, an analyst on the investment team at Innovacorp. It's fantastic seeing everyone here today for the 4th week in a row to see so many exciting ocean tech startups in attendance. As Shelley said, this is the 4th and final session in our investment readiness series. We are distributing the slides and videos for all the sessions to attendees. We've already emailed out the slides and videos for the first 2 sessions. We'll be sending out those for the 3rd and 4th sessions, today's session shortly. Any questions about these, please reach out to me. You can find my email in the reminder email for today's session or on the final slide of the presentation today. That's it for me for now. Again, welcome, and I'll pass it back to Shelley.
Perfect. Thank you, Jennifer. And a big thank you to Jennifer for organizing this series. So a few housekeeping. When you're not speaking, please stay on mute. We're recording the session. John is open to questions throughout the session. So probably the easiest way would be to raise your hand through the reaction icon, or to put something in the chat. And Jennifer and I will also monitor the chat too. So let me introduce John. So Jonathan Saari is an investment director at Innovacorp. So in this role, he identifies prospective investments and conducts all aspects of the investment review, approval, and closing cycle, such as screening opportunities, analysis, due diligence, and making recommendations to the investment team. John has over 5 years of experience in founding, financing, and growing startups, combined with a history of advising Fortune 100 companies on capturing value through their IP portfolios. He has been a co-founder and eventual CTO of a startup. He's been entrepreneur in residence, and he's also been an IP consultant. So John has a Bachelor of Science and a PhD and a postdoc. So welcome, John. The floor is yours.
Yeah, no, thank you, Shelley. Genuine pleasure to be here. Always happy to have the opportunity to speak with founders building the next generation of, in this case, ocean technology companies. So thank you for the introduction. I figure I like to provide a little bit more context around those kind of things, specifically, around who I am, who I am speaking to you as today, and who I'm not speaking to you today as. So though I am an employee of Innovacorp, I'm not speaking to you today as a representative of Innovacorp. And specifically what I mean by that is, the opinions that I express herein today are my own. They don't necessarily represent those of Innovacorp. And nothing that I say in here today should be construed as or represents any kind of, 10-step plan to get funding from the organization. Because frankly, if anybody tells you they have a 10-step plan to get funding anywhere, they probably also have they'll be willing to send you, money if only you send them money first. So what I am speaking to you as today, and Shelley gave you a little bit of an insight into that, is a person who has founded companies and built teams that have raised significant amounts of venture capital from tier 1 US VCs, both institutional and corporate. I'm also somebody who's had the extreme privilege of being able to share in a lot of other companies and founders' experiences as a mentor for both 500 startups and Techstars. And then yes, also as an investment director for Innovacorp, and I've been able to deploy a fairly significant amount of money for the region in some very, very, very promising companies, actually in the ocean space. So the reason why I wanted to give you that context is because ultimately what I'm doing, or the goal for this talk, is to provide advice, right? And that advice, like any advice, should be taken, thought critically about, and then thrown away or kept and applied to your business however you see fit in the context of your world. Because all the advice that I'm giving you or speaking about today comes through my own direct experience and the shared experiences I have. And obviously that all worked within the context of those individual companies, right? So it's a tool set. What I'm hoping we'll be able to have today, what I'll be able to do today, is give you some context and some insight into how I view and how I frame my mindset around fundraising for whatever business it is that I'm building, and also when I'm thinking about businesses that I want to invest in. And the good news is, though, a lot of this is standardized now in terms of the process, how it goes through, even the legal terms around financing are basically standardized, whether through the National Venture Capital Association, so the NCVA, which is America, and the Canadian Venture Capital Association, CVCA. They all have legal docs, model legal docs, and you can go through those, and they even give different levels of variations of what market would be. And I find that reading those, going through the two books that I showed at the beginning, Secrets for Sandhill Road by Scott Kapoor, and whose name I probably just butchered, and Venture Deals as well. I mean, a lot of that, the detail and what I'm talking about will be in those types of sources. So with that said, talking about framing mindsets, etc., I am not one who prescribes generally to the level of hoopla and pomp and circumstance that is given to the startup ecosystem and venture financing world these days. I mean, to be totally honest, in my perspective, having a startup is what it was, is the same as having a band was in the 60s, right? Everybody wants to have a startup because it's the cool thing to do. And startups, bands want to get signed by record labels, and startups want to get financed. The really funny thing about that is that when you think back about the 60s, 70s, 80s, outside of bands like Kiss, the only bands you really remember or think about are the ones who were in it for the love of the music, right? So same thing with startups, genuinely solving a problem as opposed to doing it for the pomp and circumstance. So I'm going to be framing this whole conversation not necessarily in getting investor ready and closing the deal, blah, 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 blah. I'm going to talk about building a business and how financing can fit in that broader scope. The main reason why I'm approaching it that way is because really the same thing, the same things that make for good investment decisions make for good business decisions. When you're talking about institutional investors, corporate venture capitalists, it gets a little bit clearer in terms of funding options, and that they are investing other people's money. They're running a business. And we're ultimately, you've already had some exposure now into the types of funding options that are out there, some of the incentives and motivations in terms of how venture capitalists get rewarded, and ultimately how that informs their decision making. So really, it comes down to if you've made the decision to seek venture capital, which is the most expensive form of capital there is, you're doing it for a reason, and that is a business reason, and it's a good business reason. And so, if it's a good business reason to need the capital to do what you're trying to do for one of the most expensive form of capitals, so too should it be then to invest. And this is really my very, very crudely drawn. You can see that a plot like this anywhere on the internet. This is my version. In blue here, you can basically see the prescribed value of whatever company it is that you're building as a function of time. And in green, or function of time in actually any fundraising stage. And in green, you can see the inherent risk involved with that investment, right? And go figure. This defines what I would consider your corporate roadmap, right? How do I see my business growing as a function of time, and what main, I hate to use the cliche, but milestones do I need to hit in order to be able to incrementally decrease the inherent risk of my business and therefore incrementally increase the inherent value of my company, right? And there, as you've already heard, there are individual investment or funding opportunities for each stage of that company. What I really want you to take away from this, especially in the early stage, is that, yeah, it is legitimately pretty step functioning, right? And that's because when you think about an early stage company, you really have, just general, but in my perspective, you have three types of risk. You have business risk, which generally, if you're seeking venture capital investment, and that business risk could be like, for example, market opportunities. Is there really a market there? Is there anything weird with the company in terms of legal structure, et cetera, et cetera, et cetera? But when you're looking for venture funding, especially early stage, and just for context, for a little bit more context from what Shelley said about my background, is all the companies that I've started have been deep tech, hard tech companies. So not SaaS, not app companies. Like, my last one is in the consumer electronic and semiconductor business. So lots of technical risk, but the business opportunity is huge if and when it goes. So that's an example, right? If the opportunity is large enough, then generally what you're trying to do in the early stages of a company is reduce technical risk associated with the business. And you can see that as a function of time. And a lot of people like to use TRL as an example in terms of technical readiness. I don't necessarily. And there's operational risk, which tend to comes in a little bit later of, is our sales cycle repeatable? How's our supply chain look, et cetera, et cetera, et cetera. Moral of the story is, in the early stages of a company, the number of things that you have to do to decrease the amount of risk in your business and thereby increase the value in your company is kind of a limited list of things to do. They're fairly similar across most applications generally. And it's not that, it's not, again, the subtleties make the difference between each business, but generally, it should be pretty clear. And so you should be able to concisely explain what those de-risking milestones you're going to hit do, and then how that increases your chance or time to market, path to market, however you want to think about it. And that ties into exactly the fact that we talked about earlier, investment decisions are business decisions. When I'm, blame the operational background, I guess, but when I'm looking at an investment opportunity, and I know that this is the case with other people, not just at Innovacorp, but abroad, we're thinking about this as a business, right? We're not thinking about the individual round. We're thinking about how we stage financing, what milestones we need to hit for this company to grow, what's our ownership position going to be in this company by the time it grows, et cetera. And when we're trying to make sure that this business makes sense in our mind, naively as we are, because sometimes we're not necessarily experts in the space. But when you think about things like, well, I talked about it earlier in that little step graph. What real objectives do we need for this business to actually get somewhere that we know that it's scaling, and how do we measure those things, right? Even being able to concisely demonstrate that you've been thinking about that is powerful. And then, if we look through that growth path, and we look through your financial projections, yes, early stage company financial projections are wrong. They're generally going to be wrong. That's fine. But what's more, at least for me anyway, what's important is when reading them and looking at them is understanding, do we know how to quantify success? Do we know if the experiment we're running as a business makes sense? And then can I rationalize those financial projections and headcounts and associated milestones with something that makes practicable sense, right? Because if you're a company and you're saying that you're going to go from, 10 employees to 2,000 employees in a period of, or to what would effectively need 2,000 employees to be able to achieve the milestones you're talking about in a period of 4 years, that's a pretty big stretch, even in a game of stretches, which that at least venture capital is, right? And we want to get a certain understanding of unit economics, basically how the business actually goes, right? Because at least an idea that I've learned the hard way over the years is that people fundamentally pay to have their problems solved, but they don't pay for specific technical solutions. And so by thinking about whatever approaches it is that my company's using to solve whatever pain point it is that we're talking about, whatever problem it is that we see, we want to make sure that that we're not just relying on our love for that technical solution, but it's actually practically, it's meaningful in the broader sense. And the other thing is, it just by going through all these types of questions, we get to the final question of, does venture capital actually what we need, right? Because the other thing to remember is that when you are being, generally speaking, when you are being considered as an investment opportunity, a lot of times you'll see that first-time founders or early founders are hyper-focused on this round, which will come in a little bit later. They get hyper-focused on the round that you're trying to solve, but we're looking at you 3, 4, 5, 6 rounds down the line, and that's why we're trying to understand, where our way of thinking about the business can find alignment. And so, like I said, right, in principle, if you've made the decision to seek venture capital, it means you've done the corporate planning, at least with the appropriate level of surety and detail that you can, given the stage of your business, for a few rounds down the line. So you at least have some kind of plan. And the way I like to think of it, right, is if this is timed this way and they have my hands, then this is the probability or the error bar of you being right. Right, for the first 6 months to a year, you should have a pretty good idea. But then as it gets out there, it can change, and everybody appreciates and accept that. But at least we have a plan. We're making an experiment, and we know how we're going to measure and test those experiments. And being able to concisely convey that in a meaningful way to the people who you're trying to ask to join you as investment partners, because really that's what it is. Which is another thing that a lot of people don't necessarily appreciate, is key, right? Because and I have it here, but ultimately, when you are, at least a mindset for me that's worked, because it is a game of no's in the long run, is that when you're thinking about financing your business, think about it for the product-focused people. You're ultimately the product owner for your company, right? And you have a certain sprint or a certain period of time that you need to go to be able to develop certain features that de-risk, in the case of your company, that de-risk the value of your company, or de-risk the progress or path of your company, and then thereby increase the value of your product, which is your company, to the people who are buying your company, which are the investors, because you're ultimately selling long-term value to them. So when I'm thinking about it, one of those features that can come in are actually the people who I'm working with, who I bring in terms of the gaps that I have in my own personal experience, right? And I can say that in my time, I've had the extreme privilege of having a board of investors around me who were not only very understanding, and of course, held us accountable and kept us on path and on mission, but we're also added an extreme amount of value to the company, all the way from day one onwards. So I can't stress enough how important having the right partners around you, really, really matters. And I guess controversial opinion number one, with that in mind, you know, you're going to get a lot of advice from a lot of people telling you how to position your business. The one thing I'll say is that you're ultimately building your business. You're the one that's going to have to do it, and you're the one who's setting expectations with all the people that you're working with. And if you change your narrative too much away from what you think you actually want to do or are trying to do, this isn't accounting for pivots or anything. This is just saying, you know, if you change your narrative to the point where it no longer resonates with what you're trying to do or even capable of doing, one of two things, if not both, will happen. You'll attract the wrong type of investors because you've been saying the wrong things. You've been trying to change your narrative to attract the wrong type of investors. In which case, you'll have terrible expectations, terrible expectation management for the future, and it can be rough. And two, you might, you know, it just you know, might not be the business that you actually want to build. Which is not to say, and again, which is not to say don't listen to people, don't take you know, critical advice or advice critically, and think about how to build your business, and don't be afraid of pivoting. None of that's what I'm saying. What I'm saying is, whatever you're doing, know what you want to build, do your diligence on yourself and your business, know really where your stage is, be your harshest critic in terms of what your opportunity is and what you feel you need to be able to measure that experiment. Because by being your harshest critic, you will put yourself in a position where not only you have confidence in what it is that you're doing, or how you're doing it, but also how to measure how you're doing it. And you'll know who you need to join you, which is where you do the diligence on the funding partners that you want to find. And because you have that level of confidence in what you're doing, you can be open and honest about it and transparent. I mean, there will be some of you, I'm sure, who don't do that. Just like there are some venture partners or funding partners out there who aren't as open or honest or transparent. But in my experience, and you know, the shared experience of others that I've dealt with, you know, you don't gain anything by gaming people this early. And the best way to avoid doing that intentionally or otherwise, I wouldn't doubt it. I doubt anybody would do it intentionally, but is to just make sure that you've done your homework on yourself and you've done homework on the people you're trying to attract and why, so that everybody can be aligned in it. And that's just me telling you to because it makes life a lot easier in the long run. Because you know, in the early days, every bit of help counts. And so, you know, you've already had some, I mean, at least through the material that's been presented already, you've had some introduction to the different types of incentives and motivations that happen with different type of funding partners. And I'm sure some of you have already done this before, and I'm just, you know, hopefully you're still awake. But really, for me, you know, financing on both sides of the table is ultimately sales. I've always taken a kind of a win-win attempted approach, not one of those art of the deal type people, because these are long-term commitments that you're making. There is no short-term way out of this, or there's no, any short-term game really just hurts you in the long run. And so I think one of the most important things to do is to understand as best you can, and I'm going to speak generally about things in terms of how people are incentivized and what aligns, you know, what their motivations may be in terms of doing these types of investments. And again, these are generic personas, obviously. So, you know, they're kind of listed here right now in terms of distance from money, right? I mean, angels, generally speaking, and even some family offices, although they sometimes have outside managers do it, are investing their own money. The decisions end up stopping with them. They get all the return. They also make all the decision. Sometimes, you know, you have angels who are investing purely for impact. Sometimes you have angels who are investing because they like the founders purely. Like there's so many different reasons and so many different incentives and motivations for angel investing that it's just, you know, the easiest thing for me to say is that generally they're the ones who make the decisions. When you start getting institutional investors, right, you're getting that one step further away from the money that you're, venture capital firms have their own commit, and you have some venture capital firms out there where the general partners are the majority of the commit. But generally speaking, general partners, who are the people who do the investing, are investing their limited partners' money on their behalf. And that limited partner, they're allocating somewhere between 5 to 10% of their whole, investment portfolio onto venture capital. And you have a whole bunch of general partners who are competing for that limited partner's money. So, and you've already heard that most funds in venture capital don't do that well, which is of course because most startups don't do that well. Any function that's driven by a power law itself will be a power law. So everybody, general partners are really vying to try to find the best companies that they can, right? And same thing with the best startups. They're trying to find the best founders or funds that they can. And then you have, but at least generally with institutional investors, yes, there can be some impact involved. Institutional investors are trying to drive returns to their LPs in a 10-year or so period, because that's the average length for a fund, although there's new types of funds coming out. And so they're looking for big wins generally, and they're anticipating a portfolio of companies. Out of that portfolio of companies, generally only 1 or 2, maybe 3 will be the big hits. And then you have corporate venture capital, which, again, generically speaking, they tend to be tied to the strategic interests of the corporation that they're part of, right? So, they too generally have a financial mandate, but they're also trying to think about, okay, what business unit would this be useful for? Can I get a business unit buy-in, and will there be a sign-off? And then they have all the corporate approval. They have the varying levels of corporate approval structures. And then you have sovereign wealth and government, which, huge amounts of money, generally not going to be the types of investors that I think the majority of the audience will be talking to. But same type of thing. They're generally looking at things that are strategically interesting for their country or province, or things that they think could be really big. That really matters is understanding how that decision-making process is done, and then understanding where the rewards come from and how they're incentivized. And those 2 books I said at the beginning speak a lot to that kind of stuff. So, I've kind of highlighted or led to this slide where this is ultimately the goal, right? And especially in this case, dealing with ocean technology focused companies. It's not a sector that I'm 100% familiar with, but I think it's pretty safe to say that it's a fairly nascent, from a venture capital perspective, sector. So, there's already going to be a smaller number of funds necessarily that would have you in what's called their fund thesis, which I'll talk about a little bit after this. So it's already harder in general. When you want to basically, especially if you're trying to attract outside of funds who don't necessarily think of the ocean or ocean technology specifically as an opportunity, right? You're trying to stand yourself up above the many different funding options or startup options that these funds have, so that you can find ultimately who your perfect partner, or the person you believe will not only provide you the money you need as a long-term partner, but give you a lot of value in your company. That's the ultimate long goal, right? And hopefully what happens is that you found a fund where your company matches the thesis, and you found that individual partner. Now, one of the classic questions is, how do I know what a fund's thesis is? And even at Innovacorp, which is a fairly small regionally located fund, and as only one of the members of one of the three investment directors, I get emails from people just cold emailing us or emailing me who are based in the States or in Europe or something, and they're saying, oh, would you love to invest in our company? And I'm immediately thinking, you didn't even read about what we do, because I can't. And so that's I believe Mike in one of the first things mentioned that warm intros are really important. The reason they're really important, another thing that you can do is what I talked about, which is really highlight why a specific venture fund and that specific partner is good for you. And the good news is that all of these funds are trying really hard to tell you what they want to invest in. And then generally the fund managers themselves, have everything from blogs to the Twitter to blah, 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 to tell you this is what I'm interested in and these are the types of things I want to invest in. And, there's two reasons for that. One, it's their level of interest and it's the markets that they think are exciting. But two, we talked about the limited partners and general partners. Oftentimes, not always, but oftentimes what happens is when you have limited partners allocating money to general partners, they specify areas that they're allowed to invest in. So they can't actually go outside of it, whether that's geographic or technical or like sector, it depends from fund to fund. So they try really hard to highlight what they can and cannot do. And I have here 3 examples of generalist kind of full stack funds. Sequoia basically says, we invest in everybody, but only the cream of the crop. And we back you for a long time is what I ultimately read from those types of things. And down to Amplitude Ventures, which is a Canadian fund based on life science. And everything they say is that we invest in life science, the stage we come in, et cetera, et cetera, et cetera. So even a cursory view of the different types of funds theses from their websites can to some extent differentiate you from at least the ones who don't. And I did say at the beginning that these tend to be fairly generalized processes. Ultimately the goal is to get to the point where you close. But the timeline for these types of things can range anywhere from a few days to a week to a year, depending on the type of fund you're talking to, depending on the level of diligence they need to do, depending on the stage of the investment. But basically it's, like it says here, first meeting, some initial diligence to understand how it fits within the thesis effectively. More often than not, you'll end up in some kind of partner pitch. Sometimes the term sheets come before or after the partnership or partner pitch. I've got it here. You negotiate a term sheet. That term sheet gets turned into a lot of legal documents. And sometimes there's more diligence that's done after the term sheet's been issued. And then you move on to closing. And that's generically how these things work. And like I said, this can take anywhere from a week to a year, depending on the stage and nature of the fund, the stage of the company, and the nature of the fund that you're talking to. So these are numbers that I made up, but they kind of they generally represent how these funnels work. And I kind of said earlier that fundraising is sales on both sides of the table, and it's true because outside of angels, pretty much every funding organization is trying to compete. Angels to some extent too are trying to compete to get the best deals possible, both so that they can make returns for their fund, but then also raise their next fund, et cetera, right? And it's their job to sit through as many, in varying levels of seniority in the fund, to sit through as many meetings as possible. That's basically how they spend a lot of their time, that and also helping the portfolio companies. But there's a lot to sift through in the different stages. And it can become, like I said earlier, it's a game of no's, but it can become pretty daunting going through those various stages, especially when you consider, or when you try to think about, okay, then how is it that building my business, going through this fundraising, I've gone through all the diligence on myself to create a plan, how do I differentiate myself amongst the peers that I'm fundraising against? And I think Mike hit on it a little bit in the first talk. I mean, warm intros are very strong. But at the end of the day, you basically have to be able to concisely convey your plan. And you've had some hints as to how to do that through, I believe it was Andrew Ray who told you how to, kind of gave you the Sequoia standard deck list of these are the things you need to outline. And we see a lot of those. But it still strikes me to this day, because I didn't really appreciate it as much when I was on the other side of the table. But it really strikes me to this day how much, even though these decks all follow basically the same formulaic approach, how much somebody who's capable of clearly outlining the business objectives they need to hit, the milestones that represent the check mark on those business objectives, the amount of money they need and how they're going to execute on it, like that being conveyed, you can convey that clearly through a deck. And that is, even though all these decks look the same, right? Even though all these decks look the same, it really comes out. And I mean, of course, it's pretty individual to each individual partner or person about what strikes them. But for me, it's crazy how much you can see it. So that's ultimately how if you think about your 10 slide deck or 15 slide deck or however you want to convey your message, right? Take your go-to-market slide, right? Like that go-to-market slide, it has, or at least, in my case, would have a lot of other slides behind it, right? Or different ways, or a lot of basically thought and modeling and content behind it that I have gone through enough and questioned myself enough on and challenged myself enough on, that I can concisely convey exactly the 2 or 3 or 4 things. Because again, really early stage company, there's not a whole lot that you're going to need to think about. At least there shouldn't be a whole lot that you should be tracking in the really early days to see if your experiment is working or not. Right, but I've done all that work for that one slide. 100 slides worth of work has gone into that one slide, like 5 words and something, right? And it's very powerful, and you can tell, at least, maybe I've convinced myself that I can tell, but you can tell when people have done that work. And oftentimes it isn't through complexity of story, it's through simplicity of story. Right? It's through simplicity and confidence of story, and you can back it up. Anyway, so the other thing to remember when you are financing is that if you've done all of that work and you do have that compelling, concise story that you can convey, that's a lot of C's for you, that you can convey clearly, there's another one, then the best defense when financing is a good offense, right? And the joke is that startups are always raising money, and it's true. And you're always talking to the partners that you're trying to target, building what is effectively an aura of execution, right? Saying, I'm going to do this and doing it, and then giving the updates that you've done it. That's advice that's on the internet everywhere. But the goal ultimately, right, and I've been subject to this myself, is to get people interested, get them competing on the deal or joining in on the deal, and then oversubscribing your deal to a significant amount, but not taking the money, just getting to choose which term sheet or which fund you want to go with, right? I've lost deals that way already. I've won some, but I've lost some that way. And, you know, it's been my message to people all along is funds are looking for the best founders and founders are looking for the best funds. And that's the nature of the game. It's a two-way relationship, right? Now, so I'll talk about me. How do funds assess an opportunity? Well, I've already, again, this is generally speaking, every fund is different, every angel is different, every person's different. But generally speaking, I already kind of hinted at it. One of the first kind of filters or early stage filters when you're going through decks really is, does this even make sense? And does this align with my fund, period, right? That kind of first 15, 30-minute call, or when you email the deck, I'm looking through it, I'm thinking, okay, does this make sense? Does this fit the thesis of my fund? So for example, if I'm thinking from Innovacorp, can I actually invest in this due to geographic restrictions or what have you, or thesis restrictions? Is the deal the right stage for us? Is it too early? Is it too late? Things like that, right? And then once, that kind of initial checkbox is done on, does this broadly fit the thesis of the fund or the firm? I start thinking about, okay, if this company succeeds, by the way, you kind of have to take that benefit of the doubt as contentious and contrarian and cantankerous as we can get, or at least I can get. I'm sure in your eyes, if we ever interact and I'm ever doing diligence, hopefully you don't think that way, but you might. The baseline of all of my questioning and the baseline of all of my thinking is that you're going to be able to do what you're saying you're going to do. I'm giving you the benefit of the doubt that your technical solution will work. What I'm trying to figure out now is, if your technical solution does work, give you that benefit of the doubt, which will de-risk over time. Will this actually operationally be feasible through scale, which we, again, later stage of the company probably won't involve my participation at that stage. I'll think about will be around that. And then is the business opportunity genuinely there? Right? That's what I'm trying to assess. Because at the end of the day, if now this isn't the case at Innovacorp, but at a normal fund, right? If that fund is going to return a significant amount of money to our limited, and it's not normal in the sense that we only have one limited partner, it's the province. I mean, we don't have private limited partners. We still generally think of investments in the same way. Am I going to be able to get the return that I need from this company? Because in principle, though I believe that all of the companies that I invest in, I have to have the confidence that all of the companies I'm going to invest in will be able to return, or what's called move the needle on the fund, because most of them won't. So, when I'm considering, let's say company A comes in, I believe them on their opportunity, I believe them on their technical stage. More importantly, I believe them on their technical development roadmap, and I believe them in their customer development roadmap, and I believe them in their product development roadmap. And I'm going through what they've told me. I'm thinking about the unit economics on my own side, and I'm saying, okay, if I can deploy the amount of money that I'm allowed to deploy at Innovacorp at the stages that I'm allowed to do those deployments, will my ownership position in this company, when it comes time for that exit, be significant enough, or will the exit be significant enough that I can return at least 3 times the money on the fund so I can return it to the LPs, because every company has to be able to do that. That's my personal thinking, and I've heard of it. I've heard of it from others. For example, where you have the classic two body problem, or two company problem, where you have one company that exits, really early, for, let's say, $20 million. It's, it 2x's. So let's say you invested $1 million in it. So that $1 million becomes $2 million. You get $2 million back, and you got it done in like a year or two. That sounds like a really good deal. And it is for angels and for some other people. But generally speaking, $2 million return isn't really going to move move the needle at all on, say, $100 million, $50 million, or even 500 million. It's not at all on a $500 million fund. You know what I mean? And so all the effort and founder and partners' time that's gone into managing that business, that's not generally what they're looking for. There are some funds out there who take different perspectives, but generally speaking, because of the amount of time and effort involved, there's only so many portfolio companies that a fund can have. For that reason, just because of resource requirements that it takes, those companies have to be able to hit big. So anyway, that's basically it, right? When you're thinking, when you're talking to funds, when you're thinking about your own business, when you're thinking about valuations, et cetera, et cetera, et cetera, just remember that there are return economics that the fund managers are dealing with themselves, right? Because they raise money too, right? That's the fun thing. That your general partners that are investing in you need to raise money again, and they raise money by showing that they can make good investments in good companies. So, some things that come up are, what are other things that you need during the financing process, before the financing process, when you do go out, right? Besides a deck. First and foremost, especially for companies at this stage, because it's, more hard tech companies, is references, right? We're going to want to talk to customers. We're going to want to talk to people who know you. Because especially the earlier you go, the more the investment is about the person, the team, than it is anything else. I mean, team is always paramount. Market and team are always paramount. And so those are the two things that we're ultimately going to want to get validation of, right? And so if you are, if you're a partner dependent organization where you're doing pilots, we're going to want to be able to call those partners and pilots and say, hey, if they can do what they say they can do, will X happen or will Y happen, right? And that's just me personally. I can't speak for everybody, but generally that's my understanding of it. And in your data room, you're obviously, I'll give you my list of requests for later stage investments for data rooms, and that has been requested of me as well in companies. You're going to want evidence of technical and market validation of some kind, generally speaking, right? You're going to want some level of quantifiable evidence, and that technical, for example, of technical validation, if you're a process or, you're trying to come up, it can even just be as a function of time. You have dollar per output, as a function of scale that you're doing, and you have data points that show that and this is where the current market value or current, commodity value is. You show yourself getting closer and closer and closer to beating that, right? Because at the end of the day, what we're assuming, if what you're doing isn't establishing an entirely new market or a new way of thinking or new doing, those are really exciting. But those are also very few and far between. As much as we like to think differently, they're very few and far between. So if what you're doing is either going to be significantly cheaper and better than what other people are doing, we need to see the path of how that's happening and where you are on that path. Or if you're in the lovely position of doing something that's going to make somebody else more money, which is always a good place to be in, we need to see where you are on that path and getting to the point of proving out that fundamental value prop is there. Demonstrated ability to execute is a little bit of a contrived statement, but I kind of talked about it earlier when I was saying, just reaching out to partners, talking with founders, showing that you can actually do what you're going to say you can do relative to the scale of what you're trying to do at the stage of the company, right? So what I mean by that is, if you're telling me that you're going to go from, again, 10 to 2,000 employees in the next 2 funding rounds, then I need to have some reason to believe that you're able to do that or capable of doing that, whether it's from past experience or, I don't think, just something like that. And then financing takes a lot longer than you generally think it's going to take. And that's another big thing that you see a lot is people underestimate the amount of time these fundraisings take. So my rule of thumb is, or not rule of thumb, but general advice is assume a minimum of 6 months to closing. If it's faster, it's better. It's great. But whenever you're doing those kind of plannings and milestone settings, try to line it up so that your milestone is going to hit, 6 months or so away from when you need the money. And then, a really good lawyer can help a lot, especially one that actually does venture financings in terms of market or understanding market, because you can get caught up in a lot of unnecessary details when there isn't a decent amount of institutional knowledge in the law firm about financial transactions, specifically, not necessarily, let me rephrase that, not just financial transactions, specifically early stage venture transactions. A lot of that can be negated though by just using the CBCA or NCBA documents as building blocks for what it is that you're doing. So, I talked about, the data room. Looks like a lot, but remember, in principle, you've done a lot of planning for your business, right? Because you're not doing this to start a startup, you're doing this to build a long-term company. So this is more of a diligence list that I would send out to kind of seed or later stage companies. It doesn't all need to be there, but these are the types of things that I want to see. And by want to see, I mean having information on these types of things can really help differentiate you and the level of seriousness of your organization from others, right? I mean, these can be as simple as like one pagers or decks that explain in higher detail, because in principle, you've gone through the thought experiments to figure out how all these things will play out in the future. And this is just where you put them, right? Everything from making sure your IP is in line, making sure your finances are there. Yes, you do need finance. You need financial projections. You always kind of run into the two categories. One where people say finances don't matter for startups because it's not going to mean anything 3 years from now, blah, blah, blah. I'm not going to invest in that person. Me personally. Then you have the people that do the financial projections like 10 years out for the level of detail that it's absurd. What I'm really looking for, and I kind of hinted at this before, is do we have an understanding of what success looks like as a function of time for this business? And is our measurement of success reasonable to the growth of the organization? In terms of basically, there's a certain amount you got to spend, there's a certain amount you're going to make. And do I see how these two things play out? And does it make sense to me? And you, obviously, I mean, this is the other thing to remember. I haven't said this yet, but this is all a fluid conversation that you're generally having with the partner that you're working with, and you're doing the diligence on the partner as part of that to understand where their thought process is, to see if they're really going to be a value add partner to you or not. So assuming you've gone through that diligence and you now have gotten to the point where you can get to a term sheet, you've done deals before. I mean, term sheets exist not just in venture financings. It's literally in the name as to what they are. They are sheets of paper that broadly outline the key terms that you have in the financing. The one piece of general advice I would give is it pays dividends, no pun intended, given terms. It pays dividends to be as concise as possible and to have as solid understanding as possible with your investing partner, so whatever the partners that you're trying to invest with, to work with, on these terms beforehand, because loosely worded language in the term sheet it doesn't often, but it can lead to misunderstandings and miscommunications and missed expectations in the formation of the legal documents that follow, and then it can get expensive. And anyway, venture deals and Secrets of Sand Hill Road blow these out to more detail, but really there's economics and control, right? So economics is who gets what and when specifically, and control says who decides what and when specifically. I have here listed other matters. I mean, if you're, sometimes there's side letters involved in terms of, projects you need to have if it's a CBC, corporate venture capital, et cetera. There's just some other stuff, but generally it's economics and control. And just like when you're, making a product development roadmap and you're building your company's plan, remember that you have a financing plan as well, right? And once the investing partner has made that kind of emotional decision to invest, you can work with them to create a precedence that works for both of you, because unless you're getting Sequoia or Kleiner Perkins or A16 or some of the other like full stack funds, most of the people who are funding you at some point will probably have other funds and other investing partners coming in at later and later stages and dictating terms. So believe it or not, in the early stage, you're both aligned. If you're both in it for the long run, you're both aligned really on getting the best possible terms for each other, because that sets the precedent for each and every subsequent round. Which is the other piece of advice that I would generally give you now, is even if you haven't raised money, you can make a shareholders agreement, you can do vesting agreements, you can do all of these things that will show up in terms. And not only will that differentiate you as an individual who's thought about the long-term, course from the business risk side of your organization, but it gives you a starting point, at least for negotiations. So, yeah, I don't know. I do some other more in-depth talks on term sheets for people, and it really boils down. They're not scary. Like they are. There's a lot of effort being put out. I don't want to use the word democratize, but to simplify the financing process. Like I said, National Venture Capital Association, Canadian Venture Capital Association. Read them. They give you an incredible amount of insight. The deals that I generally do follow those. So they're not scary. Don't be afraid. And don't be, just know what you need and know what you don't need. And make sure that you're working with the funding partner across the table from you to set the best possible terms for both of you in the long run. They aren't also a guarantee of financing, though they're usually a good sign that the deal is going to go through. They do not guarantee a financing. That's fund dependent in terms of how much of it is, as to whether or not the deal will go through. They are not legally binding. Now, again, I should say this in terms of beginning into context of who I am and who I'm not. I am not a lawyer. Nothing of what I'm saying today should be considered, nor is legal advice. Consult your own lawyers. But they're not legally binding. Some parts of them can be, like no shop agreements and confidentiality. But generally, they're not legally binding. And more importantly, neither are they the end of negotiations, but they're not the end of they're not your actual financing documents, which is why I said being as clear and concise as possible, and making sure you're aligned and have a good understanding with your funding partner is important, because they're not necessarily also the end of negotiations. So, like I said, the economics controls basically price of the company, what type of securities they are, what your ESOP's going to be and when it gets played out, who gets paid what and when in terms of liquidation preferences, vesting controls, and anti-dilution terms, which is basically down round insurance. All of these types of terms are covered, and they all tend to deal with who gets money and when. For better or worse, sometimes you'll see that early stage or first time founders get hyper focused on valuations for companies, and they ignore the rest of the terms, specifically on economic terms. And that can be, depending on the funding partner you're working with, that can be an unfortunate distraction. So just to give a quick, again, the books go into them in a lot more detail, and I can later if you have any questions. Also, if you have any questions about anything I'm talking about, feel free to reach out to me. I genuinely do this because I love it, not for really any other reason. So in terms of liquidation preferences, I'm sure that most of you are familiar with it already. There's broadly really two types. There's three, which is none, and then there's participating and non-participating. Participating means, so if I say, for example, I have 1 or 2x participating, what that means is I get my investment money back first. So say I invested $1 million in you, I get $1 million back, no matter what the exit number is. And then of what's remaining, I get to participate in my ownership position. So say it's 10%, I get 10% of what's left after the million I get. So I get $1 million plus 10%. That's what, participating means. Non-participating, so 1x non-participating is pretty standard. It basically means it gives us a little bit of downside protection, but it gives no upside unreasonableness, which is saying we get our money back or we convert to common and we share the proceeds as a function of our ownership position. The interesting thing that can get played into there is basically the payout terms could be something called waterfall or pari passu. I always say that wrong. Basically means do all the series of shares get paid together, or do they do a waterfall? And normally, as you go later and later and later, you can start to see waterfalls play a role. And generally, the number one waterfall is preferred and then common. Investing agreements you should all have already, and they are standard. And honestly, I'm a perfect example. The odds of a founder leaving a company, even if it's doing really well, happens, and you need to have some way of fairly controlling for the value that has been created and also the value that will continue to be created without the founder there. And that's what vesting agreements are for. So control terms. These are things like establishing the board of directors, following back to what I was saying in terms of finding the right investment partner. I've had questions about whether or not boards make sense for early stage companies. If I've done my job and my opportunity is phenomenal, I've been able to attract a really strong partner who fills gaps in my own experience, I'm going to want them to be involved in the business. So I'm going to want them on my board. So obviously that's the ideal situation, but that's up to you. Generally, boards in the early stage should be, in my perspective, should be kept fairly small and agile. You end up with things, then there's the protective provisions, which basically say, without the agreement of the, investors, you can't do X, Y, or Z. They're normally things like take debt, change control of the, change the number of shares, or issue shares senior, et cetera. Again, the CBCA and the NCBA have explanations for all of these terms and the terms themselves. And then the two books I had at the beginning outline them really nicely. Registration rights are a good thing. They're a good problem to have. Pro rata is also, generally a good problem to have, but it comes down to thinking about when you're planning out your business. It's the continued participation of your existing funders, and remember that those funders sometimes they'll get into your business early to help you because you're out of their normal thesis, but they really like what you're doing and they just want to work with you, so they can do an early stage investment, and then they're planning on getting their ownership position later. Or they've made all of their ownership position early, and they've done their economics to expect a certain ownership position later on. That's where pro rata can be really helpful. And I know I sound like I'm being hey pro VC at this stage, but again, just pragmatically speaking to all of you, in my experience, if you go in with the mindset that they're your enemies or that they're in some way trying to screw you or you're trying to screw them, it's just not going to work. It's always worked for me to try to find the best kind of win-win for everybody. Obviously, just by the nature of it, it's a truism. But if you go in with that mindset, it makes life a lot better. I mean, there is the old adage that the best way, the way you've had a good deal is that nobody comes out happy, which is partially true. But anyway, I'm looking for partners. I'm not just looking for money when I build businesses. Information rights, who gets to know what and when. Stock restrictions, when you get to sell, how you get to sell, how exits can happen. And then everything else is, again, pretty standard. I would strongly recommend going through the NCBA, CBCA on these or reading the books. I'm going a little bit quicker because I'm conscious of time. I want to have opportunity for questions. So really, even though they are standardized and nothing scary, this is why I say there is no 10-step plan to raising money, and anybody who tells you there is probably got some snake oil for you. They are standardized. The process is fairly standardized, but every company is different. Every value prop that even even when you look at the decks of companies and they all look basically the same and they're all working in fundamentally the same space, they've all got different tweaks. They've all got different tricks. They've all got different, Twix is a wonderful chocolate bar. They've all got different ways that they're approaching the problem. So it's the subtleties that make the specialness in all of these deals. And that, I can't emphasize enough how important, at least for me, from my perspective, how you don't gain anything by not being both clear and concise, but open and constructive, because you are building a partnership in the early days. That's not going to work. Remember, I said at the beginning, this is just advice that's worked for me. It's advice that's worked for some people that I've worked with. Take it, throw it away, use it. Just think of, the only thing I would ask is you think critically about it, and whether or not it would apply to your business. So you've got the term sheet. You've got the term sheet done. Especially if it's later stage and it's a price round, those terms that you've talked about will now get turned into huge sets of documents, which is why it's really good to be as concise as possible, and by concise or clear as possible, and have as good of alignment as possible with your funding partner. And by that, I don't mean it's legalese. I mean that you say explicitly what you want. An example being in valuations or when ESOPs are created, pre or post money, how conversions happen. It makes it better in the long run, and helps you manage the relationship during the actual later legal and drafting of documents, which you will have to do because the funding partners, lawyers, and your lawyers will be going at it, working off the term sheet. The more clear and more concise they are, the easier it is to manage the relationship during that process. So now that you've done it, you've got your money, it's in the bank. Congratulations, you've just started. It doesn't end here. Hopefully you've gone through this and you've been clear and transparent, because you've just set a whole bunch of expectations for yourself. You set a whole bunch of expectations of your business. You have a whole bunch of expectations of your funding partner. If you've been clear and transparent and you've done your homework on everything, you haven't made what is already an incredibly hard thing to do, and something that's incredibly unlikely to be successful, which is, a long-term startup. You haven't made it any harder for yourself. In fact, you've made it a little bit easier, hopefully. And so, to that, I would say keep being awesome. And just, enjoy the next 16 to 18 months and start fundraising 6 to 8 months before that happens. And the last thing I want to say is the three things. I call them the three gaps. They get talked about in those books as well. And it's knowledge, value, and time, right? And there's two perspectives to these gaps, and these gaps come in through. And if you're talking about even some of the most successful repeat founders, they've done 10, 20, maybe 30 deals. 30 would be a lot throughout their lifetime. You contrast that to some of the larger firms, and they've done hundreds to thousands across, sometimes across the globe, in which case, there's a significant amount of institutional knowledge, not only about the space you're in, and the startup space specifically that you're in and your competition, but also just what's market and not market for a company of your stage. There's a significant knowledge gap, and most of that knowledge is, not readily accessible. So just keep that in mind when you are approaching these funds. It can be daunting at times, but really it's a good thing because they can help you and you can learn a lot from them in the diligence process. Then there's the value question, right? Again, this is generally speaking, say you're building a company in a space. To you, it's everything. You've invested a lot into it, and you may also be very invested in your personal technical solution for whatever the problem is, right? But if you're speaking to a targeted fund, then you're one of many, many, many companies in that space that they've looked at and talked to. And not only that, probably one of many, many different types of solutions. So how, the sense of urgency and value in a company, right? It's more than just your technical solution or your company itself that differentiates you from other people. It's you and the partnership that you're going to have with that person. It is a relationship game both ways, but it is a relationship game in a lot of ways. So just remember that, you know, the funds generally are looking for big wins in a space, and you may or may not be one of them. And the funny thing is, you won't know. You won't know until it's too late from either side, right? And this is the time. This is a big one, and this is, you know, for anybody of you who may become future VCs or future funders or angels because your companies become hugely successful, which I hope happens. The time crunch is real, and I've gone through this myself in terms of needing the money now, thinking only about this round versus thinking about the future from the fund's perspective, right? So these are the three real gaps when it comes to incentives and motivation alignment between companies and venture funds from my perspective. And just keep them in mind and try to think about how they influence not only your approach to the relationship, but the funding partner's approach to the relationship as well. And if you can have strategies to kind of mitigate these gaps going into it, or at least have your eyes open about them, then you won't get blindsided by them when you are going through the process. Anyway, I guess, yeah, for me, that's it. There's supposed to be a slide here that shows the question and Jennifer and Shelley's emails, but for some reason it's not there right now. So I'm going to go back to the beginning, and I'll open it up to any questions that anybody may have for anybody who still happens to be awake.
That was great.
Yeah, awesome. My phone's acting up.
Yeah,
Go ahead, Jennifer.
Yeah, no problem. Thanks, John. That was fantastic. So yeah, without wasting any time, let's get right into the questions. So it looks like, Drew, you had the first question in the chat there. Would you like to come off mute and ask?
Yeah, well, it's something we're concerned about as we march along our technology development. We're reaching for TRL7, hopefully 3 or 4 months from now. And we're looking at that period between 7 and 9 when we may be looking for fundraising. We haven't got a product yet. Any particular advice about this process when you haven't got a finished product?
Yeah, sure. So, you know, well, I've done it, you know, we've gone through it ourselves in my past businesses. And that's where the whole references, and it depends on the nature of your go-to-market and how you're actually selling to people. But what you're ultimately trying to convey is that you have a significant understanding of not only the technical hurdles you need to overcome, but the timeline for those hurdles to be overcome on your path to market. And obviously, the less, you know, the further you away are from actual market entry to get customer validation, depending on the type of customer. For me, anyway, it's, are there people that I can call that would say that if this actually happens, would you want it, right? Because what you don't want to end up generally, and I personally wouldn't want to end up in this situation, because you can think of it as, you know, design verification, depending on the engineers here, you have proof of concept pilot testing that leads to design verification that leads to, to engineering verification, leads to design verification that leads to mass production, right? You have these kind of little gates that you have to go through that have different levels of investments for both your partners or your customers, and then, you know, different technical hurdles, and there are different stages of the company. So if you're making a widget, or if you're selling to a large, you know, a large enterprise organization, I would just want to know, I would want to get confidence that we know exactly how much money, well, exactly is the wrong word. We have a good idea as to what those hurdles and burdens are going to be to get to market, to get launched, and that we have a reasonable, you know, that we're checking and monitoring the right things. So for example, you know, if your concern right now is, say there's a certain efficiency number you need to hit, then I need to be able to see what the development path for that to hit that efficiency is and when those efficiency numbers are going to come down. And what would be really powerful is if you had a backwards graph showing that you've been hitting milestones, getting to that point, right? Or if it's a cost issue, well then, there's always learning curve theory and all that kind of stuff you can go in once you start getting to mass production. But that's it. I don't think all of that's caveated, of course, with the greater the business opportunity, so the lesser the business risk, the more technical risk generally people are willing to take on early.
Thank you.
No trouble, Drew.
Great. The next question is from Anil. Anil, are you there? Would you like to come off mute and ask your question?
Yeah, hi, Jennifer. Thank you very much. John, thank you. Sally, thank you. Wonderful session. A very quick one. There was a slide there you mentioned about the space which VCs are into. So my question to you was, is Innovacorp purely into ocean tech only, or it is more generalist like Sequoia Capital?
It would be great if we had a few billion under management. No, we do have theses. We do have sector theses that we follow. Climate tech, life science, and ocean tech. Ocean tech is one of them. I kind of talked about corporate venture capital earlier, and I like to liken Innovacorp as in between a sovereign wealth government fund and a quasi CVC, where we're acting on behalf of the province who views certain sectors to be strategically relevant to them, and so we make investments in things that we think will help drive that strategically relevant sector for the province, right? So no, we definitely do ocean investments. We're definitely focused on the ocean. We believe that we can and will continue to be one of the leaders in that space.
Okay, great. Just along with that, so basically, I am into this online marketplace space. It's more of like trying to say bye to the traditional e-commerce and trying to bring the future in. I mean, that's a kind of a space I am into. So could you help or guide or at least advise any generalist VCs available in Halifax, Nova Scotia?
Yeah, well, I mean, we have, not even necessarily generalist. I'd say one of the best examples. They're one of my personal favorite funds in the country is basically made their names purely investing in marketplace plays. It's not in Nova Scotia; it's in Vancouver.
Okay.
But just to that point, I mean, there are specific funds who will hit marketplace plays both in the States and Canada. Yeah, I mean, we have build ventures, we have concrete ventures here who tend to invest in not necessarily things that are specifically ocean, life science, or climate tech focused. They're a little bit more generalist, and also earlier or later.
Any particular specific names you could share?
Yeah, like build ventures and concrete ventures. So Patrick Henkinson and Rob Barber and Patrick Keefe are
okay, great stuff.
Build in concrete. Not to say we don't do those investments. We do those types of investments. We're just more. We just have a pretty big focus specifically on life science, ocean, and the old climate.
Yep.
Need to have climate for the companies to matter.
Wonderful. Kunal, you're next up. You have a question about valuations. It looks like if you'd like to come off mute and ask that'd be great. Kunal, if you're here, I'll just read it out. And then if you're there, feel free to interrupt me if you'd like to. So his question was, for professional investment, is it needed to be assessed by a professional agency for valuation? If so, which agencies are available in-house and through collaboration at Innovacorp?
Nope. Is the easy answer there. It is not necessary.
Perfect. Moving right along, we have another question from Kunal. It says, in an ideal case, would you have angel investors on the board of directors or not?
Well, if, you know, that angel happened to be a hyper-connected person who built, you know, a business and sold a business in the space that I'm working in, then heck yeah, I would want them on my board for the same reasons that I would want any operator VC or other heavily financially connected VC, right? It's all about how, if, you know, regardless of whether they're angels or investment partners, if they can add value and fill out gaps that I can't have, and the odds of me being able to hire them are incredibly low, which probably are because they're at that stage of their career, then yeah, I'd want them on the board or an advisory board of some kind, right? I don't know. From my perspective as a founder, the only job I really had was to be kind of shitty at everything. But the one thing I needed to be good at was finding people who were substantially better at me than pretty much everything and convincing them to work with me.
Wonderful. Let's see, that's the end of the questions in the chat. It looks like Fadal, you have your hand up. You can go right ahead.
Thank you. That was a great session. Thanks for all the insights. So my question is, when looking for investment, which is better? You look for people that would give some of your equity, or looking to take loans and then pay them back, so you can maintain control of your company?
Yeah. So, well, yeah. So venture debt's a thing. It's a good thing. You know, again, it depends on, generally it's easy to answer, but specifically is where the details matter, right? It depends on the organization. You know, oftentimes, well, you end up in situations where you have companies that are so still operationally risky and technically risky that no one would finance them through debt, right? They just, you can't be secured that way. Generally, when you get to the point where, you know, you start to have a little bit more market validation, you get to be a little bit later stage, then yeah, you know, you can get different types of debt. And I know that my colleague Ben spoke to these, but I think my best answer I have for that is, if you need the money now to do something that will greatly de-risk your business, and I know this sounds incredibly cliche, but it's the best, it's the only way I can really answer it. Then whatever pathway you have to access that money, you should explore them all. And one being better than the other depends on how you see the future of your business playing out. Because debt can suck too.
Great. I don't see any other questions at the moment.
I'll jump in. I put links to CBCA and NACO, their templates in the chat. So they've got access to that. And this wasn't arranged, but this is my holiday reading. The exact 2 books that John had up. So that's what I'm doing over the holidays. But at the end, Jennifer will send out an email out to everybody. And if you reply back, we'll actually maybe do a draw for maybe about 5 or 6 of these and send out to you.
Wonderful. Let's see, we have just a few more minutes left. John, I'll jump in with one question that I hear quite often from companies, which is, you know, if you're raising and you have a lot of soft commitments, but you're really kind of having a little bit of trouble getting someone to lead, getting that first term sheet, do you have any advice for someone in that position?
Yeah, I mean, it can be beneficial to have people who have soft committed already. Again, it's talking about the narrative when you are approaching people and being open and constructive, right? A lot of funds will be pretty straightforward about their investment strategy when it comes to leading or following. So you're not usually going to fall into that kind of problem. You should generally know up front if a fund leads or not. And when you're dealing with angels, there's not really much in the way of advice you can give, because it's every individual is different in terms of how to make that decision trigger. It's an emotional decision. We can quantify. We can try to quantifiably validate our emotions any way we want, but ultimately, at the end of the day, it's an emotional decision that you need to push that person towards. And then it just comes down to ultimately the fund's investment thesis. Some funds only do follows. Some funds only do leads. The glib answer is just keep talking to people. Yeah, and I guess just to kind of end off on one thing, I know it doesn't feel like it, and I've been through it. But one of the happiest moments I had when I was going through all this stuff is just to remember that at the end of the day, you really are both in this together, as perverse as it sounds. You're offering something, they're offering something. And if you go about it, like I said, if you take that mindset in the whole thing, a no isn't a no, it's a not with us. And you can learn something from every single rejection. Well, rejection is the wrong word. You can learn something from every single no. About not only how you're presenting your business, because oftentimes when you're making these pitches, you think you're saying something, but people are hearing another, and that can sometimes be an issue. So there's always be learning, always be thinking critically about why something went the way it went. Because again, at the end of the day, barring on both sides of the table, there's bad actors, of course. Well, that's not the right thing to say. There are different actors with different motivations. But I don't know, from my experience, there's good people on both sides, and it really is a win-win when things work out.
Yeah, that's great advice.
Yeah, those are great words to end by. John, thank you so much for presenting this afternoon. Lots of information there, just for us to think about and for the companies to help them as they become investment ready. So thank you once again. Big hand of applause. I'm going to pass the final word over to Jennifer.
Thanks, Shelley. So one other thing I just want to mention, those who would have attended our previous sessions would be aware of this already, but in case we have anyone new today, which I think we do, we want to let you know about a special opportunity that we're offering to attendees. This is an exciting opportunity to win free coaching sessions with Sarah Colburn, who is a local strategic communications expert. This coaching will focus on developing your story, marketing yourself and your company, and refining your pitch. We will be sending out an email shortly now that the series is complete with more details on how to apply. Criteria we will assess will include things like your current or prospective Nova Scotia footprint, stage of your company, market potential, technology readiness, and so forth. So stay tuned. That's a great, valuable opportunity, and we'd love to see you apply. And lastly, I'd like to say thanks again to John for the great session today, and to all of you for attending. Stay tuned for those follow-up emails with the slides, links to the videos, the draw for the books, and details on applying to the extra coaching sessions. It's been a real pleasure hosting you over the last 4 weeks. Please feel free to reach out anytime. And thank you, and happy holidays.